Ambassador Singla, Chairman and CEO of FEDAI, other industry organizations present here, CCIL, FIMDA, and others, participants of the foreign exchange market in India, my colleagues from the Reserve Bank of India. I think the foreign exchange market has come of age when Mr. Shamsher Singh referred to the role played by RBI in containing the volatility that we saw recently. The response was conspicuous by the silence that it gave. Which is an indication that if you have two opinions about it, let's discuss, right? In any case, I'll come to that point a little later. This is about FEDAI. And I think it was mentioned that earlier this year, in January, FEDAI was accorded the status of a self-regulatory organization, an SRO. Congratulations to FEDAI. In fact, this discussion about FEDAI, about SROs has been coming up. If I remember right, the first time these issues were discussed were in the early part of this century, around 2007-8. And that time I felt something, and which I feel even today, that FEDAI is in fact the closest we have as an industry body to self-regulation. It is the closest we have to an SRO, even otherwise. What RBI has done is merely recognize it formally. And I hope FEDAI continues to do this work that it has been doing since what, 1958, that continues to play that role. And in fact, I see a larger role for FEDAI, not really because it's been recognized as an SRO, but because of the way events are panning out all around us. I would like to talk a little bit about how our markets in general, but I'll focus on the foreign exchange market, has been evolving, which would place in context some of the recent developmental and regulatory measures that Reserve Bank has taken for us to assess how do we go from here. I have been involved, in fact, I think I was part of the team that used to do intervention in the 1990s, 97, 98. So I have seen how the market has evolved from those days onwards. In between, I was, of course, away working more on the interest rate side. But then, like someone said, once a dealer, always a dealer, I always had an eye on what's happening in the forex market. India has set a very ambitious goal for itself. It wants to be counted among the developed nations in another 2 decades' time. A lot of things have to happen if India has to reach that goal, and we are committed we would. The economy has to be strong. The financial system has to be strong. Indian institutions and businesses should be good enough to compete globally. Banks, other corporates should be able to compete globally. Indian financial markets should measure up to the best standards, best global standards that exist. How are we going in that direction? So far, it's very encouraging. India stands out as one of the few shining examples where, notwithstanding the volatility and the uncertainty and the geopolitical pressures that we see on economies, we are still the largest, fastest growing of the large economies. We grew at 7.6 last year. RBI is projecting a growth of 6.9 this year. Inflation has been under control. Inflation is projected at 4.6, well within the band that we have. Banking system is robust with capital adequacy well above whatever is required in terms of regulation, above 17%. Gross NPAs are down to just above 2%. Net NPAs are about 0.5%. The financial system is strong. Markets go up and down. That is no reflection on the health of the financial system. So the financial system is also strong. The Reserve Bank has been preparing over the last many years, but particularly focused over the last about 5 to 7 years on giving the Indian forex market a better global role, a more important global role. Two important initiatives that I would like to focus on. That Reserve Bank decided and took regulatory measures to put that into play, that we need to have one price for the rupee globally. We cannot have a situation where there is a break between the onshore and the offshore market for the currency. Wasn't an easy decision. If you looked at the latest BIS data at that point in time, the volume of rupee transactions, in foreign exchange transactions, was higher offshore than it was onshore. But we decided at that point in time that we have to give our banks the leading role in terms of setting exchange rate for the rupee. NDF was linked to domestic markets, and that process has been going on for the last, about 5 to 6 years now. And by and large, in fact, I would even venture to say that it has worked in a way that went beyond what at least I personally was expecting initially. Local agents have been playing, local markets, local market makers, local corporates have all been participating a lot more than I expected in this market. Simultaneously, we have made it easier for non-residents to operate in our onshore markets. Now, this is an important step that happened, and it is working very strongly. The second important step that we took was that India cannot aspire to be a globally recognized, developed economy if its currency is not commonly recognized for global transactions, used for global transactions. Here I don't mean that it should have a share of global transactions that competes with the current global currencies. No, I don't have that in mind. But I do expect that the markets would be open, free, cross-border businesses, capital as well as current account transactions would be using rupee, would be looking at rupee as one of those currencies with which we can do cross-border transactions. A few years back, we started this process of internationalizing the rupee. When it was done, I remember fielding a lot of questions on are you trying to be a global currency, are you trying to compete with the dollar? And at that point in time, I've told what I just told you, that we just want to be another currency that is globally recognized. The same goes for institutions. If you have to be an advanced economy in 20 years' time, we have to have banks which are globally recognized, and business is done globally through our banks, at least one or two large banks. That is essential. Now, these are not things that happen like putting an electric switch on or off. They are slow processes. They involve change in the way corporates look at currencies, our own currency, in the way global banks and other market makers look at our currency. The process has to start. And given the right conditions, it will pick up pace at various points in time. So we have started that process. We have to now go forward. We have to enable Indian banks to be able to borrow and lend in rupees outside, transact in rupees outside, allow settlement between two completely different countries to happen in a rupee if that is what is required. The underlying conditions have been set. These are the two important things, important measures that I think would determine the way the forex market moves in the next couple of decades. Now, this requires also that businesses are able to manage their risk freely. Again, a few years back, coinciding with the other measures that I just referred to, we freed up hedging and managing risk, foreign exchange risk in our country, not just by linking it to NDFs or allowing NDFs to be used, but in terms of the way corporates have freedom to do those transactions. That was, we created a protective environment where we said users can be either retail or non-retail users. Retail users need to be protected. Non-retail users, it depends on bilateral appetite for risk. Any products can be given to those users. That system has been working very well. The second thing that this requires is gradually the markets will have to play the role of creating market efficiency, managing discipline, market discipline, containing market abuse, and the role of the regulator should gradually go down. And one of the basic measures of this is gradually move away from prescriptive, rule-based regulations to principle-based regulations. The one I referred to in terms of hedging regulations was in that direction. That was one of the first ones to happen in that direction. I'll give you an example. When I came into this forex regulatory aspects, the department I came into, every day there used to be at least half a dozen references that teams had been sort of dealing with pertaining to hedging of commodity risk. I don't believe that these things are approved at a central bank level. The central bank has no skill or knowledge to be able to decide whether a particular hedge is to be allowed or not to be allowed. It has to be left to the market forces. If there are concerns in terms of forex flows, those specific concerns can be addressed, but they can simply be addressed through a proper reporting mechanism in place. So we just freed up everything at that point in time. And from that date to this date, I do not think there is any one case on commodity hedging pending for RBI's approval. So markets have to be given that responsibility. Markets have to mature gradually, not only in price determination, but in meeting the requirements of discipline, meeting the requirements of the small players in the market, and generally working towards improving market integrity. On this, FEDAI has an important role. Now we know, I think it was also told before me, that FEDAI used to act as a bridge between the Reserve Bank of India during days of exchange control, but even subsequently under FEMA, between Reserve Bank of India and the foreign exchange market that is there. But we have now to look at taking that a notch higher. I remember in some other context, when I was discussing about SROs, someone asked me, said, if you think they're working as SROs, how many disciplinary actions have they taken against members? Zero, right? It's a self-regulatory organization. It has to have rules that members agree to adhere to. And whenever any member does not adhere to it, the body, by agreement of members, takes disciplinary action so that the incentives get aligned properly. That's the fundamental function of an SRO. If this function is done properly, the need for a regulator to step into the market would not arise. While I'm talking to FEDAI here and SRO to think over this and work out, discuss with your members and carry out the framework and the arrangement through which this can be done. You have to set your own rules and standards of behavior. That's exactly what an SRO does. That's what guilds used to do in the past. Pretty much the same that SRO does. We all know, and the global financial crisis of 2007-8 that started in 2007 has, clearly shown this. Markets are very efficient, but markets tend to overshoot. Markets tend to misprice risk. Someone has to step in. The agreement then, after the global financial crisis, was that governments or regulators will have to step in. But we must also remember this issue didn't come up at that point in time, that all standard setters have to step in. All SROs have to step in. I don't think there is enough of a global debate about the role that other standard setters played in creating the situation that led to the global financial crisis. I'm just focusing on the SROs. So even SROs could have played a role at that point in time. They can play that role now. So one is this, and to be able to do that, you need the agreement of all members. You also need the agreement of all members so that information flows to the SRO, quite distinct from regulatory reporting or other things, that the SRO has the information to be able to take these decisions. decisions about how standards should be tweaked, decisions about getting new standards in, decisions about disciplinary actions, everything. It's not easy, it's tough, I know, because I used to tell it to FIMDA when I was involved in that work some 10, 15 years back, or 20 years back now, that this is mispricing. Please take action. I don't think it was easy for FIMDA to take action against members. The framework isn't structured as one. We have evolved in a framework where these bodies act more as market voices, which is good, which is exactly what is required when the market is evolving. But you have to now move over to a role which is not just that of a market mouthpiece, a voice, but also a self-regulatory role that you need to play. Others too need to play that role, including FIMDA and others. We expect that role to be played by even non-regulated fintech entities, which is why we have recognized those entities as SROs. So this is, I think, the way FEDAI needs to proceed, and to be able to do that, you have to have your own data flow that you will have to develop. Information has to flow to SROs, to FEDAI. I don't need to be able to talk to 10 different people. Our departments don't need to talk to 10 different people or 15 different people over a period of time to know what's happening. We expect that FEDAI gives that information to us. That should be the first port of call for any problem in the market. So I expect that FEDAI as well as the other ones will think about this, think deeply about this, and work out a framework, an agreement among members that addresses this issue. The second aspect, and this will be the final one, I know, we don't have much time. The second aspect, and this is not something that has been discussed much before, I want to discuss about is the role of market makers. Every market requires market makers. They are the ones who provide the products to the users of the market. They are the ones who enable the market to manage its risks, the corporates and everyone to manage their risks. They have a very important role to play, very significant role to play. But they also have an obligation, right? Market making is a privilege. I don't know how many of you realize this, but the real money in financial markets is not done by getting trading calls right. Most of the money in all the financial markets is made by this small bid-ask spread. That is the only consistent way that money is made. And if you are a market maker, you have the privileged access to just that business. It's a privilege. You get a lot of other privileges depending on which market you are in. Access to liquidity, access to information, access to, we're discussing with the central bank and other policymakers. There are a lot of things that come with being a market maker. Now, I know we have, we've been, our markets are not that old. It's just 2.5 decades. Before that, we hardly had a market interest rate or exchange rate. So it's still a young market. I know these responsibilities are not the first thing that comes to mind when you think of market makers, banks, primary dealers, or whoever they are. But I think markets have matured enough for us to start debating what the role of a market maker should be. And the primary role of a market maker is to ensure that the market is functioning efficiently. If it sees problems, it can approach the SRO, the regulator, and alert them to the reasons why market is not functioning properly, what needs to be done. there is a difference between a market maker and an entity that is there purely to put capital in taking risk and getting the consequences of it, make money, lose money, whatever. There's a difference between a bank and a hedge fund, right? Banks are market makers. So we will, as market makers, have to look at a few things. We'll have to look at, number one, are the most vulnerable users to access this market, are they getting a fair deal? I have been telling this for quite a few years now, I'll just repeat it. In a market where the daily global volume is 700 billion or higher now, I've lost track of that number, to get a spread of 2 to 3%, don't matter what size of the transaction, is an abomination. It should not be there in a market. Today, if I have to go and buy dollars or buy euros to come here from my banker, the banker or whoever is made the price tells me that I'm giving you a 50 paisa spread, and that's a very good spread because you are from the Reserve Bank. Look at any other market. With this kind of a volume, how are they justified? Again, remember that you have been authorized so that people come to you. This is the privilege of the market maker. So are retail entities getting their due? That's something that you need to look at. How is the pricing to retail entities? I'm not listing things out. I'm just showing some examples of what, as a market maker, is our responsibility. The second thing that you have to look at is the price determination happening in the best possible way? And this is where the justification for what Reserve Bank did recently comes up. I'm sure all the participants, they are all very sharp, intelligent and experienced participants in this market. I'm sure everyone realized that the kinds of trades that we were doing was sucking away supply from a market already reeling under pressure because of global events, because of how the global capital has been moving. We all know that. We all knew that. We all also knew that these kinds of transactions simply took the supply of dollars away from the market. Why did we continue doing that? You see, what is considered fair game changes when markets do not do their price determination function efficiently. Please think of what happened in the early 1990s in the USA. The most liquid and the largest market in the world, the US Treasury market. You all know about the Salman Brothers episode, right? That they just bought some, various entities bought some government security treasuries and cornered them. It became such an important issue that one of the highest level of committees that I have seen at that time, they sat down and they laid down rules of how much you can actually hold. In simple terms, they were laying down the rules against hoarding. Right? Same here. I remember one of those days, someone said a large inflow, very large inflow has come into the market and rupee dropped 70 paisa. Right? So obviously, it was just not coming, it's just not getting used. Now these are situations where it is possible. We haven't thought ourselves like that. We have thought of our role as just making a price and then managing your own position in the treasury. While that is important, that is not the fundamental reason that one is a market maker. So when we announced it on that day, we expected that people will get the message, understand it, and bring things down. If there's a problem, they will approach. But the way you saw the market the next day was something which was an eye-opener for us. Right? Again, all that happened was these positions, barring a few, just got shifted to corporates, and everyone knows, none more so than market makers, that corporates are not allowed to take on arbitrage positions in India. They are supposed to hedge. Arbitrage is not a hedge. Corporates and many others, I won't go into those details at this point in time. That was, that was an unfortunate development which forced our hands to take steps that we thought should not be taken in this market. Last it was taken was probably 10 years back, I don't know, I don't remember. That cooled down the market, that did what it was required to do, only a bit, because we track transactions, we know what's happening. What this episode is telling us as a regulator, and that's what I want to convey to you, is that our financial markets, the role that market makers need to play needs to be reinvented, needs to be understood. Privileges don't come without responsibilities. We have to look at that, we have to do that. Any situation where things get cornered are not transactions that are justified just because every single transaction is legal. So I think this would be the best thing that could happen to our market, in addition to the role that SROs play, the role that market makers play. We can set an example for the rest of the world. We have set an example for the rest of the world in many ways. And if you're committed, you can set an example. India's bond market infrastructure is uncomparable. There is no other market, doesn't matter how developed it is, where every single transaction, every single price is available in the public domain. I was once asked to invest as reserve manager to invest in a particular currency. So I said, where are the prices available for these bonds? And they said, you come to me. Not a market, which is something that as a reserve manager I would go. We are fully transparent. Every single transaction settles on a guaranteed basis. We started that in 2001. Europe and US took that up after the global financial crisis. USA has still not done it fully. Right? We have done that. We have a system that is unique, the India's home system. So the infrastructure, we have set an example. We have set an example in many other ways as well. I won't go into that. I think let us all think over, discuss, led by the SRO, FEDAI, on how we should ensure that the role of the regulator goes down over a period of time and the responsibility for market integrity shifts to the market itself. That, I think, is what I thought I should convey as a message to all of you. No need to get bogged down at this point in time. You can enjoy the beauty of Paris for today and tomorrow. But this is something, let's begin a discussion. Please approach the concerned, if you want support and thinking, approach the concerned departments. Talk, let's talk and settle these things over a period of time. This will take time, I understand. But please begin the debate on this. With that, I want to thank the ambassador for taking the time to come here and participate in this discussion. Our discussions with the market, especially, I try and keep it heart to heart. I tell them what I want to say. They can tell me what they want to say, maybe not publicly, but individually many of them have. So, thank you very much. Thank you. Please have a great conference.